You're thinking of moving to Portugal and you're on the lookout for the perfect property. There are many fabulous locations in the country where you can consider buying, from the buzzing capital of Lisbon to the wonderful beaches in the Algarve. But one important question that is sure to crop up is, how are you going to finance that property? You'll be pleased to know that the Portuguese mortgage system is quite favourable to foreigners, although there are some differences that you'll need to be aware of depending on whether you are a tax resident of Portugal or not. In this video, we'll provide you with everything you need to know about the Portuguese mortgage system, including the process of securing a mortgage and the different mortgage types on the table. Hi there, my name is Amy and I'm a buyer's agent at Goldcrest, the independent property buying service in Portugal. At Goldcrest, you the buyer are our primary concern, not the seller, and we will always negotiate the best possible deal for you, ensuring that you have the latest market intelligence and innovative valuation methods to make an informed decision. So, as we already mentioned, it's entirely possible to take out a mortgage in Portugal as a foreigner, and you'll find a very few different options depending on what you're after. The mortgage process takes about 6 to 8 weeks, so we recommend getting ahead of the game and getting to grips with the mortgage system as early as possible. There's no harm in being overly prepared when it comes to securing the best mortgage deal for you. Your broker can assist you with understanding the timelines for paying the deposit, while also letting you know about the approximate timings for completion and potential delays. The Portuguese mortgage system usually follows this process. The first step is for your broker to get a mortgage quote on your behalf. You'll then submit the application form. If the application is approved, you'll get a formal offer in writing. Your broker can then assess it, discuss it with you, and confirm the terms and conditions. Following this, the bank will then carry out a valuation report on the property before the completion arrangement. This is where you'll need to transfer the funds for the purchase to be made, and the lender will continue with the mortgage application, and you'll together agree on a date for the completion. And on the final straight, you'll arrange the payment. And when the property and mortgage details are all signed in front of the Portuguese notary and the taxes and fees are all in order, you're done. You have your dream home secured. Yes, navigating the Portuguese mortgage system is not too difficult. You'll definitely want to have an experienced broker on your side who'll be able to assist you with the process and help you with any queries that you may have. Probably the most important part of taking out a mortgage anywhere is being aware of how much you'll be able to borrow. And in Portugal, this will depend on whether you're a tax resident in Portugal or not. But don't worry, as even if you're not a tax resident in Portugal, the deal is still pretty good. So to set the scene, the maximum amount that you can borrow will depend on the ratio of the loan amount to the value of the property pledged as collateral. This is known as loan to value, or LTV. For tax residents, the LTV allowed can be up to 90% of your next home or permanent home, although this is reduced to 80% if the property in question is a second home or a holiday home. Non-residents have a maximum LTV ratio of 70 to 75%, which is also a pretty good deal. This ratio can also vary slightly depending on the bank. There will also be some additional fees that you'll need to take into account in addition to the deposit. Fees include a €290 application fixed fee, a €280 fixed valuation fee, stamp duty tax at 0.6% of the mortgage, and 1,200 notary, registry and tax office fees for mortgage deeds. Another important question that you'll want to ask yourself is what type of mortgage you want. In Portugal, there are two options. You can opt for a fixed rate mortgage or a variable rate mortgage. A fixed rate mortgage allows the buyer to pay a constant fixed rate for a certain period. This protects you against fluctuations in the European base rate and is usually pre-agreed with the bank when you're requesting the loan. While a fixed rate mortgage can be fixed for the entire lifespan, it is more common that it's fixed just for a certain period and then reverts to a variable rate mortgage after that. And what is a variable rate mortgage? Well, basically what it says on the tin. This is where your monthly payment will fluctuate depending on the index, usually Euribor, the benchmark for calculating interest rates for mortgages. Over the repayment period, monthly payments are normally revised every 6 months based on these rates. And one more thing we think that you should be aware of is that if you decide on repayment, you'll be charged 0.5% on the repaid capital. And that's a wrap. We know that it's a lot to take in, and if you'd like some extra info, you can always check out our article on mortgages in the link in the description below. Please don't forget to hit like and subscribe. My name is Amy, and this is Goldcrest Insights.